Today, we're going on a little journey. We're going to follow a single product, tracing its path from a warehouse shelf all the way to a final number on a spreadsheet. Why? To uncover how a business really knows if it's actually making money. I mean, have you ever picked something up in a store and just thought, after they pay for the product and the shipping and the rent, is this one item actually making them any money? It seems kind of complicated, right? Well, today we're going to pull back the curtain on that exact mystery. So let's start right here. For a business that sells a service, like a consultant, figuring out profit is pretty straightforward. But when you're selling physical stuff, it's a whole different ballgame. See those two new phrases on the right? Cost of goods sold and gross profit? These are the secret ingredients, and they're going to be key to understanding the whole story.
And yeah, that fundamental difference is exactly what we're diving into first. We are stepping into the world of merchandising, a world where inventory is king, and the product itself is the hero of the whole financial story. You know, this simple loop you see here is basically the engine of any business that sells products. It's called the operating cycle. You start with cash, you use it to buy stuff to sell, your inventory, you sell that inventory, and then you collect the cash, so you can start the whole cycle all over again. This little diagram is going to be our map for this whole explainer. All right, so let's follow that map. We're going to begin at step 1, the moment our product officially enters the business. This is Act 1, the purchase. The story pretty much always kicks off with a document that looks like this one, a purchase invoice. In our example, a company called Smart Touch Learning just got a bill from their supplier for 100 tablet computers. This right here is the official starting pistol. So let's just break down what actually happened in plain English. Smart Touch Learning now has 100 new tablets sitting in their inventory, ready to be sold. But they haven't paid for them yet. They've got the stuff, but they also have a bill for $35,000. Now, here's how an accountant sees that exact same event. Merchandise inventory, which is an asset, something the company owns, it goes up. At the exact same time, accounts payable, a liability, which is just a fancy word for what they owe, also goes up by the same amount. The scales are perfectly balanced. But if you look closer at an invoice, you'll often see something called credit terms, like this 3/15 N/30. What's that? It's basically a deal from the supplier. They're saying, hey, if you pay us back within 15 days, we'll knock 3% off the price. If not, no big deal, just pay us the full amount in 30 days. For a business owner, this is a huge deal for managing cash flow. And this is why those terms matter so much. By paying early, Smart Touch Learning pockets a cool $840 discount. And that's not just free money. It actually directly lowers the cost of their inventory on their books. They've literally made each tablet cheaper to buy, which means more profit is baked into every single sale they make down the line. Okay, another crucial little detail on that invoice, shipping terms. This answers a really simple but vital question. While all these products are on a truck somewhere between the seller and the buyer, who's responsible if something goes wrong? Well, the invoice decides. It really boils down to two main options. FOB shipping point means as soon as the goods leave the seller's warehouse, they belong to the buyer. The buyer's responsible, and the buyer pays for shipping. FOB destination is the complete opposite. The seller's on the hook for those products until they are physically delivered to the buyer's doorstep. So let's just recap Act 1 here. To find out the true cost of your inventory, you can't just look at the sticker price. You have to start there, then you subtract any discounts you got or returns you made, and finally, you add in any shipping costs you had to pay. That final number, that is the actual real cost of getting that product on your shelf, ready to sell. Okay, so we've figured out the true cost of our inventory. It's sitting there on the shelf looking good, and now a customer walks in. This brings us to the most exciting part of the whole cycle. Welcome to Act 2, making the sale. And just like a purchase, a sale gets its own official piece of paper, the sales invoice. Here we see Smart Touch Learning selling 5 of those tablets to a customer, Pendleton Dentistry, for a grand total of $2,500. Okay, and right here, this is the key to everything we've been building up to, so listen close. When a business like this makes a sale, it's not just one event. It's actually 2 things happening at the exact same time. You have to record the money coming in, and you have to record the product going out. And we can see that 2-part process right here in the books. The top entry, that's the sale. The customer owes the business $2,500.
But the second entry, that's the magic. At the exact same moment, the cost of those tablets, $1,750, moves out of the inventory account and is officially recorded as an expense.
So, we've purchased our inventory, and we've made a sale. We have all the pieces of the puzzle. It is time for the climax of our story, calculating the true profit. That expense we just recorded, it has a very special name, cost of goods sold, or just COGS for short. It is, quite literally, the direct cost of the specific merchandise that you just sold to a customer. This isn't some estimate, it's the actual cost of the item that just walked out the door. And when you take your sales revenue and subtract that cost of goods sold, you get probably the most important number for a product-based business: gross profit. This number tells you exactly how much money you made from the pure act of buying something and selling it, before you even think about paying for rent or salaries or anything else. So let's zoom out. Imagine our business does thousands of those sales over a whole year. Here's how it all comes together on their final report card, the income statement. Right at the very top, you see net sales, minus that cost of goods sold we just talked about. And that gives you the all-important subtotal, gross profit. It's only after you figure that out that you subtract all the other operating expenses to find the final bottom line, net income.
And honestly, this is the ultimate takeaway. Gross profit is so much more than just a number on a page. It's the heartbeat of the business. If you aren't making a healthy profit from the simple act of buying and selling your product, then no amount of cost cutting somewhere else is going to save a broken business model. It's that fundamental.
So there you have it. We've followed the entire journey of a product from just a line item on a purchase order to being a key part of the final profit calculation. It's a detailed story, but it's a really powerful one. So the question I want to leave you with is this. Now that you know the true journey of your product, what story are your numbers telling about your business?